and CFOs of software companies like myself. I mentioned the World Financial Symposium that we sponsor and we chair in London, but as well as on the East and West Coast once a year. M&A workshops throughout the globe, mostly North America and Europe, but also Latin America and Asia. Publish leading M&A research. I hope if you haven't seen the annual report that we were distributing in February, please get back to us. We are also quite experienced webinar broadcasters. One month we do a tech M&A update. It's attended by over 5,000 executives throughout the world each year. And we have plenty of experience in M&A, so we've done over 270 transactions. On to the presentation. What I'm going to do is keep putting exactly the right pixel here, to take you through a number of slides which are going to give you a macroeconomic view of the world, starting off in the east, moving west, and drilling down into technology and the ramifications thereof on M&A. So with China, as we see, the company profits have fallen this recent past. In fact, in the first quarter, this is because of the economy slowing down in Europe and other reasons, but also they have their own issues with inflation. The government's trying to control that by increasing interest rates. In Japan, the consumer and business surveys are showing that it's still a challenge to recover from this extremely high yen. In October last year, it reached peaks, post-World War II peaks in the economy, slowing down to 6% growth. It was only 3 years ago growing at 9%. This slowing down in China and India is also being seen in the raw material shipments from Australia, which are down. So lots of sputtering in that Asian growth engine. Moving over to Europe, we're all very aware of some challenges in the European economy. UK retail sales down, French business confidence stalls. Perhaps no surprise as the elections look like the politics will be shifting a bit left in France. Manufacturing shrinks in Europe. Surprising big drop in manufacturing in Germany. This is causing a readjustment downward of the economic growth expectations in Europe. Portugal paying 13% per year for the bonds that they're selling, 10-year bonds. This is similar to the Greek levels that we saw pre-restructuring. There was a big restructuring in March, saving them from default. $100 billion worth of private debt was basically restructured completely. Signals that Spanish risk is real, even though the bond rates are down. The ministers had to increase the bailout fund, and it's now approaching $500 billion. Some experts still think that's not enough, so we'll see what happens in the markets going forward. United States, more of a silver lining here on the clouds that I was just mentioning in Asia and Europe, especially retail sales raising dramatically. The confidence in the consumer and business is climbing exceedingly high, 8-year high, in fact, as jobs are finally being created consistently. The Philadelphia Fed chairman was in Paris last month, was saying no need for more stimulus as the economy recovers, though he's cautiously optimistic. We also have, in America, this is good news, services displacing manufacturing as a driver of the economy. That's important because it's more sustainable. For the last 3 years, since June of 2009, when the recession ended, it was the manufacturing space in the U.S. market that was driving recovery and expansion, which was a new twist. But ultimately, it's going to be the consumer driving 70% of the market economy in America that makes a difference. Looking further at finance, other central bankers in the States also agree with Plusner. No need for easing. Hedge funds are finally capitulating. They were basically betting a lot short on the market as it continued to go up in the last 12 months. You see that in the chart here. S&P, thanks to the buying from also other investors, up best quarter since 1998. Not quite as it was pre-financial crisis, but it's getting there slowly but surely. It's actually very, very healthy markets right now in the U.S. Apple plans to pay a dividend. First time we're seeing something like that, and we'll talk about their cash balance in a moment. Apple, talking about Apple, iPad 3 sold 3 million in a weekend. I mean, think about it, $1 billion worth of revenues over a weekend with a new piece of equipment. Fantastic, continuing to print cash. Though they're not infallible in China, they're having challenges against Samsung. Group, a company that Quorum has consistently warned about, had to restate their financials for the last quarter due to material weakness in their financial controls. We'll see where Groupon ends up going. Splunk IPO, very successful. It's only about 2 weeks old. Ex-Hyperion boss running that entity, CEO taking it public. Stocks are up, showing that IPOs are still alive and kicking and healthy in America. That's important. I wish it was the same case in Europe. They're the new buyers. There's enough public companies that are taken off the market by giants like Oracle and SAP, taking off the market, for instance, SuccessFactors and Telio as an example. Oracle's business, though, is also alive on the organic side, not just inorganic growth. SAP is looking to basically reinvent themselves. You know, they're 40 years old. 40 years old. They just turned 40. Great. Tip the hat to those guys. Continuing on technology, tech, M&A. It just until recently went public, and it's an example of how using public funds and the public capital to continue acquisitions. That's why IPO markets are important to us. Same time, Facebook bought Instagram for $1 billion, kind of reminds us of the YouTube transaction. This is before they're even public. Also paying Microsoft $500 million for some patents. That's a whole other topic. We've done specials on that one at Quorum. Cisco, $5 billion deal. Mentioning that one because multi-billion-dollar deals are the ones that make the big headlines, give comfort to the directors of this tier, secondary and smaller companies to pull the trigger on acquisitions. But topic for today, cloud. You see Dell acquiring Wise to add cloud desktop applications. Amazon sees further drops in cloud. Well, that's not a big surprise. Pressuring Microsoft. Well, we'll see how Microsoft react to that. Speaking of them, they're back on the top list. They were off of this list in 2010. This is the top strategic acquirers in 2011. Look at that. Google, 33 acquisitions. Since Page took over the helm, he said we're going to only be focusing on big tickets. Well, that's the case. They still seem to do a transaction. But look at this. Zynga, 13 transactions. I mean, they were private until the end of the year. Facebook, still private, 12. We haven't seen that kind of activity from private acquirers ever until now. But we also see other cloud players, Amazon, Salesforce, making acquisitions in market and keeping the activity very high in base. One of the reasons is cash. They're generating cash hand over fist. Since 2007, I mean, the financial crisis actually began in 2007 with the debt crisis, culminated in 2008 with the Lehman bust. Look at the cash balances back then. You know, what is it? Add it up quickly. It's maybe 40, 50 million. It's approaching $500 billion now. It's probably 300 billion. But I mean, that's incredible, tenfold. And a huge amount of that is offshore. Microsoft acquired Skype with money that was parked in Europe, which cost them a ton of money if they repatriated it to the States. So it's simpler for them to make acquisitions than to bring the money back. This, for instance, as well as other drivers that I'll get to in a moment, are actually part of what the phenomenon is of the recent peak M&A activity. And I'll talk about how that affects people in the cloud space as well, because I've been in this business now for 14 years. I enjoyed the peak period at the end of the last millennium, went to the next valley, which you see here in 2002, 2003, peaked in 2006, thanks to loose debt, financial crisis, peaking again. This cycles, they go up and down. Right now we have good economic conditions in the U.S., we have IPOs, good stock markets, we have great activity, and the reality is there is some clouds on the horizon in Europe. One has to worry about whether or not this phenomenon will continue forever. So let me talk about why, nevertheless, we think that tech M&A will remain strong, at least for the yes, 1 or 2 years, foreseeable future. What's out in 3 or 4 years will remain to be seen. Because if you miss one of these peak periods, you have to actually battle for another 5 years to wait for the next one. I know lots of companies that went to market in 2008. Financial crisis hit. They went up the market. They had to wait until 2012 to find a healthy market to sell. That's 4 or 5 years later. So the main reason, software rising in importance. Hey, was it ever a question to the people in this industry? Well, it was a question to IBM until about a decade ago when Gerstner changed their strategy, but HP is finally getting it now. We'll see how that continues. Large private buyers like Facebook and just recently Groupon and Zynga, but they're now no longer private. Infor, the 4th largest ERP player on the planet. Lots of people don't even know of them. A $4 billion privately held private equity backed as Attachmate bought Nova, what was it, $2 billion about a year ago. Also a private company backed by private equity. We have entrance of non-tech buyers. Bosch, for instance. We sold to Bosch a company called Inubit of Berlin. The industrials are looking to software, to technology, to increase margins. New public buyers from China and India. That trend continues. Private equity, $500 million of money available for investment. About 15% of that is earmarked for technology, but still, we're approaching $100 billion. This is not unimportant. I mean, there are transactions and recaps happening in the industry space, in the cloud space, in the hosting space that I think Mark will be touching upon a bit later. Debt, lowest ever. Microsoft is issuing a bond for like 1% because they didn't want to bring back the foreign money, and it was cheaper for them to raise capital. Strategic buyers have enormous amounts of cash, much of it outside of the U.S. This is also motivating and impacting transactions. And extraordinary change. This is mega trends. This we'll talk about that the rest of this time, and this is my way to pass over the baton to Daniel. One of those, obviously, is cloud. And most of you listeners here have been in the industry or watching it for years, but it's now finally culminating where bandwidth applies. The attitudes of the business leaders are such that they're actually accepting, moving to the cloud, their applications, and our listeners here are profiting from that, I think. So we pass on to Daniel, who will give us a bit of a state of the nation here in Europe.
Right. Thanks very much, Miro. I'm Daniel Beezer. I am an analyst at the 451 Group. My area of coverage is the Internet infrastructure stack, so it's data centers, hosting, cloud computing, all that good stuff, and with a particular focus around the European market. I think I need to control the slides because I can't drive them at the moment. And in the next quarter of an hour or so, I'm going to be of the cloud market in Europe. But I thought before we did that, it would be useful perhaps said well about the 451 Group. We have a number. We have a third-party syndicated analyst firm with a number of divisions, including Tier 1 Research I work for, which covers the service provider market within the internet infrastructure stack. And also we have Uptime Institute, which may be familiar to you as a tiering, a certification organization within the data center industry. And then lastly, we have 2 end-user research units, the InfoPro and ChangeWave Research. So start this. I want to just take a step back, because when you talk about cloud, people in the internet industry sort of rise and get annoyed and say, oh, we've seen it all before, or define terms and want to get in a huge argument over what those terms are. People outside are generally confused. So I think it's perhaps worth just spending a minute or two thinking about what on earth the cloud is. And I would put it quite simply as being it's tools and products and services that were once extremely expensive and now become very cheap and ubiquitous. This is a very familiar process for those many interested in history. It's happened to a number of goods before. In fact, you could say it's one of the main feature about the free exchange of goods and services is this ability just to make stuff incredibly cheap. So that picture there that you can see there is a mainframe computer. In the 80s, if you wanted software, you'd have to ring up IBM, and a month later, they'd come back with it and charge you a fortune. Only very large enterprises or very rich individuals with a lot of time on their hands would ever want to do this. Now, you can walk into a mobile phone shop and get a smartphone with a lot of compute power, and you don't even have to pay it. So that's essentially what is happening with cloud. It is software ubiquitous and cheap. I want to use this picture of a mainframe to point something out that people don't often talk about, which is very, very important, which is we think that everything in technology, indeed, progress is linear. We always get better and better. Well, we don't necessarily, and it's exactly the same in technology. I have a very decent-sized business translating applications that run on Sun Server OS back into Z Linux. Now, to translate that into a language, perhaps those who are not familiar with all those acronyms alike to explain, Z Linux is the mainframe language. Sun OS is a server language. So what's happened is an application has left the mainframe, the world of the mainframe, has gone out, and it's now being taken back in again to the mainframe. So we go forwards, we can go backwards. IBM, there is an awful lot of mainframes still out there. There's an awful lot of legacy IT out there that we always need to consider when we're talking about the cloud. And in fact, the very great majority of enterprise applications are still within the corporate data center, one sense or another. And it's not just the mainframe where we see this happening. We also see this happening in cloud itself. I was talking to a cloud provider who told me that they quite often get a media agency that will initially start using the cloud, spin up some instances and some storage and the like for a one-off project, and then find that project goes really well. Say, instead of cancelling it after a month, they want to actually keep it as a permanent feature. And what they do is they move off the cloud into a dedicated environment. So kind of moving back down the stack there. To take an example, Netflix, the poster child for the cloud, for Amazon, which is the leader in cloud, used to have 80% of its infrastructure running on Amazon's cloud platform and 20% running in-house. Really, it's reversed that. So now it's running 20% of its structure on Amazon's cloud and 80% on its own internal infrastructure. So it's not necessarily a linear progress towards the cloud. And this is brings to a point that I often like making about technology comes in cycles. I talk about the mainframe. Many of the features that we see today in the cloud, we see in the mainframe, such as fault tolerance. I like bringing up this cloud particularly to show you that the brown, probably mostly German audience here, these will be familiar. These are brown consumer goods, I think, from the 60s and 70s, a radio and a calculator, and of course the iPod and the Apple calculator. Remarkable similarity. But obviously, when these new products came out, when Apple brought out these new products, they were for completely different functions and for completely different purposes. Technically, it looks the same, it's the same. This is why people in IT often roll their eyes around when they hear people talking about cloud, but it's utterly different each time. And we need to be aware of that when we talk of cloud. Word on the cloud, quote unquote, overall is that the very, very confusing features of it is the way we talk about cloud in itself is confusing. And if you look at this little graph here, this little picture here, you'll see on the far left, you'll see a classic IT enterprise environment where everything is controlled by top-down control IT department. And you see moving across to infrastructure as a service where everything virtualization layer below is handed off to the third-party service provider, platform as a service, even more the databases, operating system, they're handed over. And then finally, we come to the abstraction of software as a service, software pay as you go, anywhere you like. Where really, the only thing you as an end user know about is the data. Now, you see that's the nice kind of linear progression we're seeing there. You think the most abstracted form, the cloudy, if you like, of the different types of service would be software as a service, because you really just do not know anything about the underlying infrastructure at all as an end user. You just control the data. But in the typical classic cloud nomenclature, brought up by the NIST, the American Organization, National Institute of Science and Technology, who've created the classic cloud classifications, in fact, the infrastructure of a service emerges as being the most pure perfect cloud. That is the sort of the Amazon cloud, the storage and compute, when all that's really being taken away is everything beneath the virtualization layer, so the physical servers, the data center, and the like. Just one final overall point about the cloud. There were always alternative ways of doing things. We need to bear in mind that the frame is still there. Dedicated servers are still there. We at 451 Group think that outsourcing represents 20% of the IT market. Given that everyone said that outsourcing was a no-brainer, as the Americans say, and saying so for the last 15, 20 years, that's a remarkably low percentage. Cloud will have an impact, but it's not going to be that enormous, in my view. And just to underline this point, this is a Canard Enchaîné, a very fine French satirical magazine, there's an equivalent of it, the Private Eye, and this is their website. And for those of you who don't know French, they're very long-windedly, as French people like to, what they basically say on this website is go away and buy a newsstand. And their sales are actually going up. They're not being disintermediated, devastated, etc., like other media. So it shows, there's not one way of doing things. So these numbers here I've got up are for the larger players that we see in the European market. As you can see, operating the cloud market, these are infrastructure as service revenue numbers, and they are numbers for Europe. Just to capture these in progress. This is the first time we as an organisation have had a cut at these kind of numbers. Then they're probably going to change a bit as we perfect this process, but here they are, for better or for worse. So you can see the thing that leads out from the page about this is the dominance, as it were, of providers from overseas. People often talk about how the European Union's data protection regime, and indeed the various data protection regimes running in the country in places, for example, like in Germany, where it's very tight, are quote-unquote a sort of trade protection, a means of stopping cloud providers coming over from the US and setting up business here. Whereas you can see from this chart, if that's the intention, they're actually making a very good job of it, because Amazon, I believe, has more business than the rest of those providers altogether, and only has one data center and runs out of Dublin. They have several availability zones, but only one data center is running out of Dublin, serving the whole of Europe and the broader Europe in the sense out of that one place. So the demand there, what's remarkable is you see how the revenue drops as we get down around that chart. So just some trends that we're seeing. I've recently written a very large report, an 80-page report on cloud and the European service provider market. And from that, this is really a page of the trends that I've seen. And to my point that I was making earlier about the landscape maybe not changing quickly as you'd think from the noise you hear, one of the key features of cloud is the pay-as-you-go aspect, the on-demand aspect. But into the cloud offerings that we see in Europe from those providers that I had on the previous slide, in fact, is very much the order of today. We're not being billed by the minute yet. Pay-as-you-go is not really reached the market yet in any shape or form. Feature says that a lot of the move into the cloud in Europe is really being driven by the existing players there. And the existing players there that would have an interest in having skin in the game are infrastructure players. So it's typically hosting companies and carriers. And most of them are not actually specifically interested in the kind of public cloud that we see Amazon running, the sort of cloud I put you on that third on the right, data infrastructure as a service one, which is publicly available, always on demand, that storage compute offering. What they're really interested in doing is actually moving up the stack and moving into software as a service, the most attractive one. Although they do have cloud products and they're making a lot of noise about it, most of them really see it as a long-term game, and the long-term game. The long-term game is where they essentially become software as a service providers. Another trend I'm kind of seeing a lot, not quite a good one, is the prevalence of what we want for a better to call cloud washing. There's a talk about private cloud. and there are a couple of people in my firm, not myself, I listen to, to describe private cloud as just being vapor and nothing else. And typically what we see is a large company with a large managed services business, say like an Orange business or a Verizon, who's very large, who manage the data center hosting estate of a large corporate like a BP or a Shell or an ABN AMRO. And then as part of that deal, their customer approaches them as the kind of outsourcing partner and asks if they can sell them some VMware licenses, and said carrier then puts out an announcement to the world that it's got a 40 million euro a year cloud business. So we see a lot of that kind of setting up things going on within the service provider area at the higher end, at the high price end, and also at the bottom hosting end, where they're offering basic web hosting packages to SMB and consumers, where they're saying we have a cloudy service, which is really a virtual private server, and not really the true cloud that we would recognize and acknowledge. We're seeing as a trend the emergence, or rather I'd say it's almost a continuance of London, Amsterdam, and Frankfurt as foci of the nascent cloud in Europe. I mean, there's a number of reasons for that. Probably the first one that springs to mind is the peering exchanges. AM6 was the first in London, in Europe, in Amsterdam, and then London and Frankfurt came after. And around these peering exchanges, large data center, carrier-neutral data center clusters have appeared. On top of those, most of the largest customers of these third-party data centers typically are hosters and content pushers. The reason being that these organizations tend to push a lot of data, and so they want to push it. They want to have that peering exchanges with as many carriers, and ideally with peering exchanges, either they don't have to pay for to eliminate costs from their business. And as I mentioned, so we have a data center ecosystems clustered around those three cities. And now, as I was pointing out earlier, it tends to be the hosters and the carriers that we see moving into those markets and the success of it. They also tend to be clustered in those places.
Is it possible for me to ask a question in between here?
Sure.
I was just at the World Hosting Days last month, and I saw Luxembourg making a huge, let's say, splash, trying to bowl in this space. And do you have a chance against London, Amsterdam, Frankfurt in this regard?
I certainly do. Yeah, no. Luxembourg is a very interesting proposition in this market. Actually, they, as you say, they are making a big push, and as I'm sure people on this call know, it's not just in the data center hosting and cloud market they're making a big push. They really stall out to attract the multinationals, and in fact, Amazon's headquartered there. And I believe eBay and a whole handful of well-known multinationals are headquartered there. They're having a similar sort of push because they were known as the great satellite hub in Europe. They're having a similar push for the data center market. And I think they have one of the very few Tier 4 data centers in Europe. In terms of people going there, they definitely have the infrastructure, and they put in some very impressive sort of 10 gig link type connections to peering exchanges. So it's definitely an interesting play. They're definitely putting a lot of investment in there. But, it's a question of size. I mean, London, Amsterdam, and Frankfurt have been doing this stuff since the mid-90s. And there's a lot of data centers there. There's a lot of new data centers being built. I'm sure Luxembourg could put up to where everyone is now or was 10 years ago, but in that time, then there will be a lot more data centers would have been built in London, Amsterdam, Frankfurt. So it would be tricky for them to be larger in size, but I wouldn't be at all surprised if Luxembourg becomes a major force. One of the main reasons I say that is that when companies look at where they're going to go, Europe to host or put their infrastructure, tax is usually pretty high. They never say that publicly because it's not a very good thing to put out in the public. We're trying to avoid. I mean, I don't know if any of you people on the line are from the UK, but Amazon have recently got a lot of trouble over paying tax in Britain. So they don't like to say, but it's pretty much why Microsoft and Amazon are in Amsterdam, and another strong reason why not in Amsterdam, in Dublin. And it's another big reason why Amsterdam is such a popular location as well. So I mean, that's probably a point I was going to make anyway about London, Frankfurt, and Amsterdam. Is not an issue of clearing exchanges. It's also in London. There's the language and the familiarity that overseas customers from the US have with the UK market. The same is kind of true of Dublin, but Dublin always had very poor infrastructure and still doesn't have great infrastructure in terms of network. Because don't forget that the importance of network in the cloud. It's often forgotten, but it's very, very important. Amsterdam, again, as I say, has always been, and the same with London, they've always been sort of window in the world. They've always been very open to a kind of outsourcing, internationalist culture. And Frankfurt's an interesting one. It's a very, very slow market for a very, very long time, but it really picked up. And one of the reasons for that is the gateway to the East. People, getting companies, hosters, to do business in various places of the world, like Belarus, Ukraine, and Russia, where there's a bit of risk involved in doing business in those markets, often serve those markets out of Frankfurt. A similar thing happens in the US with the Nap of the Americas in Miami. A lot of people like to host their content and serve the South American market out of Miami because the connectivity out there, the routes out there, are absolutely excellent. Just to finish off, because I think I'm running out of time here, I just want to bring a few interesting companies in this kind of space to everyone's attention. Some of them local, some of them new arrivals in the European market. Softlayer, a large text and hosting company, for those not familiar with it, have just set up shop in Amsterdam. Very interesting choosing Amsterdam as a location rather than the UK, because they want to be the Eurozone country to avoid billing issues and other kinds of regulatory risk. They didn't want to be in Germany because of regulatory risk. They didn't want to be in the UK also because of risk from the libel system as well that we have in our country. Fire as well, very interesting company, also from Texas, recently set up in Europe. They have a cloud that's completely built from the bottom up around security, security pitch, and that's something that's very interesting to the enterprise. As Amazon typically tell you that they don't engage with the IT departments very much. It tends to be other departments, the marketing departments, engage them. Fire's getting around that by making it apps strength of their security and saying you want to host your applications with us because what we have is much more secure than your data center. Some of the players I've got here are locally. There's Zimmery, who are in Berlin, were spun out of Deutsche Telekom, have a CDN database. That's a database that replicated in cache at the edge of the internet. So a classic use case for that would be a Deutsche Bahn who's filing their product. And there are lots and lots of queries also sent that timetable. Those databases get overwhelmed at the origin. So what Zimmery does allow caching around the edge. So they say 80% of all queries can be dealt with. Very interesting product. Russian company that has a web server, an open source web server. They are a developer shop built around that. And next is, I think, get close on 10% of world web server. So it's a long way off from Apache, but it's doing very well and growing very, very fast. Majestic SEO is a distributed search engine. They have over 1 million users, a bit like SETI at home, if anyone remembers that from the 90s. They have 1 million users around the world, and they've indexed 3 trillion links, which actually puts them on a par with Google. It's a remarkable resource. It's just there in Birmingham, in England. It's being monetized a bit, but not fantastically. But that's very, very interesting. And finally, a company from Olpa near Cologne in Germany, Open Exchange. They sell webmail tools to big providers, people like Orange, people who have a lot of consumer webmail accounts, and they're changing really from a webmail platform to a software as a service platform, a channel delivering software as a service to consumers. They have, I think, closed out last year with 40 million mailbox, and they're going to, they say, have 80 this year. So that can open up as a very, very interesting channel to market. So with that, I'm done. It's any questions. It will be time to hand on to Mark.
Thanks. I'm Mark Johnson. I'm with Quorum Group. I'm based out of Stockholm, as Mira said. And just quickly about my background, I've Quorum Group. I've been a software CEO and with a venture capital firm as an investment manager, as well as for IT my whole career. I think you have control here, so if you could, thank you much. What I'm going to do in this section is I'm going to go into further detail about the cloud market, and then really analyze some particular transactions and see what kind of trends these transactions are saying about the market in general, as well as cover a couple of hot sectors that we've identified. So first of all, this chart here is identifying the growth trajectory of cloud computing in general, and made up of these three sectors: service, infrastructure as a service, and platform as a service, as Daniel went through earlier. And what this chart is telling you is, number one, it's growing at a decent rate, and growing at about 127% from 2011 to 2014. Much of that growth you see is the blue section, the software service section. What's really interesting is the very small portion, the platform as a service section, growing threefold over these years. So the SaaS sector, as I say, accounts for the majority of the growth, and this is actually also the highest valued sector of the technology grouping across all technology sectors, and that's to do with the growth rates, of course, but also due to that most of these companies are horizontal in focus. They don't have any narrow market niche, not the big players. That is. The SaaS sector will continue growing, and valuations, I believe, will continue going up over the next 1 to 2 years. There is a maturing in this sector, and that will have an effect on companies specializing on certain verticals, but also have an effect on the multiples associated with the public companies and with the transactions occurring. In the infrastructure as a service, the major players there, they're the Amazon AWS, IBM, EMC, Rackspace, Satis, which was just bought by CenturyLink, as well as Terramark, which was just by Verizon. Those are the dominant players, and while these traditional hosting companies are dominating this infrastructure, the trend is to move more towards cloud hosting, particularly for larger organizations due to the scalability. And then the performance service space, the fastest growing, is made up of three dominant players, and that's Google, Microsoft, and Salesforce today. Salesforce being extremely acquisitive in growing their platform products. But I dive into specific deals. I just have a few comments, macro trends in the cloud space. Firstly, the technologies related to cloud and SaaS were among those driving deals across the tech sector in general over the past year, particularly driven by established companies buying cloud and SaaS technologies that they need to plug product or service line gaps to catch up to their customer demands, where that demand is anticipated or already manifested itself. Next slide, please. I'm going to go into just a few specific deals, and obviously these are deals in which we have first-hand insights into what drove the attractiveness of the transactions. And so the rest of my my talk here, I'm going to talk about specific deals. I'm not going to go into detail on every one of the ones I put up here, just in interest of time. I think altogether, they tell a very interesting story about what's happening in the cloud sector with M&A and growth. Firstly, we have the Google instantiations. Instantiations was acquired by the Google Web Toolkit team, and Google acquiring a tool enabling independent software vendors and enterprises to create more interactive applications for the cloud. And so instantiations, Eclipse-backed development tools enable Java developers to quickly create user interfaces using the toolkit, the Google Web Toolkit. Then we have Brother Nestis deal. Brother is a Japanese company, manufactures printers, scanners, sewing machines, machine tools, and other home electronic appliances for both businesses and consumers, selling these products globally. So we've sought to diversify in the software by buying Nestis, and this is a trend in which we're seeing across the board, which we've kind of mentioned here. For example of acquisitions like this is a printer company out of the U.S. called Lexmark, and it has bought two European software companies in just the last 6 months to diversify the hardware printer business, which it sees as not so profitable and attractive moving forward. But back to Nestis, it was founded in '98, based in San Diego, and it's an innovator in web-based remote collaboration and conferencing software. The company operating under Nestis and EPOP and Wired Red brands has developed a range of solutions for messaging and collaboration that are used by customers in the world. I'll be breaking down the collaboration sector, which we see as a particular hot sector, in a few minutes. And then we have the Lumas Advantage deal. And this is similar to the Oracle's acquisition of Tao and SAP's acquisition of SuccessFactors, which I'll identify later. But Advantage basically fills a gap in Lumas's offering, and in this case, Lumas is a European leader in the talent management sector, and it acquired Advantage to round out its portfolio with a SaaS-based e-learning platform. Okay, next slide, please, Tanya. Thank you. I'd like to talk about some mega deals. And these are really interesting because they give a good picture of what industry leaders are doing and thinking. And what's most interesting about these deals that we've identified is not just the overall value. You see values for, $2 billion, $1 billion in the case of SAP on the slide. But what's most interesting is the incredible multiples that are paid. So looking at multiples above 6 times revenue in most of these, and EBITDA multiples through the roof. And these are for mature companies. Oracle buying Taleo for over 100 times EBITDA. It's just incredible. Just how it needs that software and those skill sets into its company, but also that's what it's saying about the future growth potential of that business sector. So looking further into Oracle paying over $3.5 billion for these 2 deals alone. Firstly, now is a SaaS customer service company, which was picked up by Oracle for $1.5 million, and it pushes Oracle's cloud offering. It includes Salesforce automation, HR and databases, and most believe this was a direct target towards Salesforce.net is. But Oracle seems to be broadening its entire SaaS portfolio, so it's more distributed than that. And it's on an absolute buying spree these days. Taleo gives Oracle tools that help companies manage HR, recruit employees, and set compensation. And this was a counter move to SAP's $3.5 billion acquisition of SuccessFactors. And this deal allows Oracle to compete head-on with SAP, as well as Workday, which is a major player in this sector, which is scaling this year. Usually both of these deals give Oracle the SaaS knowledge and expertise, the DNA in a company that it needs to move forward. but a massive cost. Next we have CenturyLink acquiring Savvis. This was about a year ago, but when CenturyLink announced this acquisition, it said that the rapid acceleration and migration to cloud-based services made the strategic combination a natural choice for them. So the deal creates a managed hosting and co-location provider with global scale, and that made sense because of a shift in its way of doing business, imaging its IT services and infrastructure. And Verizon Terramark, Terramark's large location and managed hosting business, that was not exactly the core ingredients of which Verizon was looking for. It was really its cloud computing platform that Verizon was most excited about. So Terramark's recent growth in the infrastructure and enterprise cloud platforms were tremendous gains for Verizon, and Verizon's made no secret of its desire to be a name brand in the cloud computing world with its specialist as a service cloud strategy. And next slide, please. And we can move down to the next, please, Tanya, because we're out of time otherwise. Okay, next I'd like to switch gears a little bit and talk down the collaboration market, and which is a particularly hot sector right now. And we can take a look at a few of these. And firstly, just to explain a little bit about what the collaboration market is and why it's valued as it is. I mean, well, we're using a collaboration product right now, the Cisco WebEx product, and it's essentially, these are businesses which are realizing the value of providing a rich suite of collaboration applications which are accessible anywhere and on any device. And the driver of the collaboration sector is the influence of the consumerization of IT, as well as the accessibility to business applications and resources from mobile devices. And without the drivers in this sector are in mobile realm. We'll start with this Citrix deal, which was just announced a couple of weeks ago, picking up a Danish company, a VC-backed company called Podio. And this product, it's used for project management, social information sharing, and sales lead management, as well as employee recruitment management. And it also has related iPhone and Google Android applications. And while there are a lot of collaboration vendors in the market, Podio, it has a unique approach. It enables users to create their own applications to carry out specific tasks. And this allowed the team to tweak the platform to cater to specific needs. So looking at Salesforce's acquisition of both ManyMoon and DimDim, and these are pretty small acquisitions, but it tells us about what Salesforce is doing and what the market's doing in general. There were just a couple of their small acquisitions within the collaboration space. ManyMoon is known as the best project management tool for Google Apps. So in more fitting perhaps that Google would have acquired ManyMoon, especially since it was the leader on the Google Apps marketplace. But Salesforce got to it first, and now it's aggressively taking on the collaboration market. This transaction was immediately followed by the acquisition of the web conferencing service DimDim, which basically extends its chatter collaboration. And this follows the proven Facebook model of combining real-time collaboration and communication into a single integrated service. And it's proven successful maintaining Salesforce's leadership. So we can go to the next slide, please. We have VMware making a couple of acquisitions. So VMware is the virtualization pioneer owned by EMC, and it's made the big expansion moves through these acquisitions, in particular these two small collaboration vendors. So SocialCast combines a corporate activity stream that taps into CRM and ERP systems with social bookmarking, Outlook and SharePoint integrations, mobile desktop apps, and analytics. And so coworkers can share knowledge and updates in a semi-private setting, offering both SaaS and behind the firewall options. And in the case of SlideRocket, again, a small deal, it's a based online presentation application that produces slideshows that rival PowerPoint. So imagine it integrates authoring and asset management, delivery and analytics tools into a single hosted environment, allowing you to quickly create presentations, store, share, search, and all of this done securely, whether in person or remotely. So let me just round out and summarize. The cloud sector was driving overall tech M&A over the past year, and if there was one thread through across the spectrum, it was a shift of established players acquiring to attempt to solve the big data problem being faced by medium and large enterprises, and in my view, we'll continue seeing significant M&A activity in 1 to 2 years. I do believe it's possible that valuations are get to cresting above its peak. We'll see what happens. That's all for me. Thanks.
Thanks, Mark. We have a few questions from the audience. This one's to you, Mark. Do you think the high multiples in which public SaaS vendors are valued are reasonable, or do you think that's a hype?
I do think it's reasonable. I mean, it's just incredible the growth that these SaaS companies are undergoing. I mean, these large players are having over 100% revenue growth, on an annualized basis, and to be paying out multiples in the 7-8 times revenue, while that's incredibly high. I think it's a reasonable price to be paid for these companies in which we have not yet realized the full value potential of companies, and we know that there's going to be a significant M&A activity. And that's part of how the market is valuing these companies. They're both these valuations are a slice of the interpretation of not what is valued today, but what the future value is going to be of these companies, both judged by its growth primarily, its profitability, as well as the attaching a premium to what an eventual acquirer would pay for these companies, and paying back the shareholders for their ownership stake.
Mark, I have another question from the audience. This is to Daniel. How important is the geographic location of hosting data centers based on factors such as access to clean energy, legal jurisdiction, or closeness to customers?
That is an immensely difficult question to answer shortly. It's very important. I think you have to remember with data centers, with the cloud as well, that the cloud, the internet is server, client, and there's network, and the network is the string that brings those two things together. If you think of Microsoft and who run BPOS, Office 365 out of Dublin, Amazon who run and web services out of Dublin, that's absolutely fine if you are in London or you're in Frankfurt, if you're an enterprise in London or you're in Frankfurt. But how many enterprises are there of a medium size now that just have offices in those two places? They probably have software development in Ukraine. They probably have a field office somewhere in South America or in Africa. And there's a whole little ecosystem built up of accelerators of people who accelerate network traffic, specifically built up around this problem. So that says to me that although most applications aren't latency sensitive, that you see end up in the data center, quite a few are. It is very important. So there's that one issue is being proximate to the population or the group that you want to serve. That's one issue. Then there's another big issue of the whole data protection, regulation, etc., which I alluded to earlier when I was talking about software deliberately electing to go to Amsterdam rather than Germany because of the regulations, rather than the UK because it's not a Eurozone country, and as well as not being a Eurozone country, it also has libel and risk, which is a problem for a company that hosts a lot of published sites. You have this kind of risk, although I do think they are hugely overblown. I think the data protection is a bit of a marketing ploy, really, if you ask me frankly. I mean, if you speak to Amazon Web Services, say they've got one European node that serves out of Dublin, I can see they've got a lot of German customers. I've seen them. They've got an awful lot. So I think it is kind of, I've heard it characterized as the new health and safety. It's a sort of excuse for not doing what you want to do that people bring up. I think it's an issue, but not as big an issue as people think it is. And, finally, as I alluded to, tax is hugely important whenever we speak, and we speak to a lot of people hosting and on the enterprise side who are looking at where they're going to host their data center, and tax, not just tax in the sense of what tax incentives you're going to get for coming here and investing, 100 million data center, but also what's your corporation tax level? And as we know, the two lowest corporation tax levels in Europe are Amsterdam and Dublin. Dublin doesn't have a huge data center industry simply for the reason that its network infrastructure has been so poor. Now it's got better. Maybe that'll change. But those things are really critical.
Thank you, Daniel. We have one more question from the audience. This is to you, Miro. Do you think uncertainty in the European financial markets impacts U.S. buyers' willingness to acquire European companies currently? Certain markets such as France or Spain.
Sorry, mute. Yeah, that fits to what I was chatting about. Actually, a very good question, and certainly I've seen worries in certain geographical areas. When you start as down in Ukraine and whatever, Romania, Bulgaria, sometimes there are there's the attitude that it's too risky. In regard to Europe, right now we're in the midst of closing a transaction with a French company that had multiple bidders from Europe and from North America. It's actually going to be closing with an American buyer. And so we don't see that kind of a challenge right now. You see Apple buying a company like ProRose, and when there's a strategic fit, this, let's say, geographic risk in Europe is not perceived as that high. Yes, there are some issues around the Eurozone and the Euro and the bond markets, but I think the reality is most people see that, German economy, French economy, Spanish economy is not going to crumble and disappear. There's still customers to be served. So I don't see negative impact yet in the deal flow or in the deals that are being closed.
Thanks, Miro. We did have a few more questions from the audience, but we are out of time. So what we'll do is we'll post, the recording of this event as well as the presentation and the questions that were asked, as well as the answers on our website. You should see that in about 24 hours. So please do visit our website. Here's the information down there, www.worldfinancialsymposium.com, and you can find the information and contact details for our speakers today as well. Thank you again, everyone. Thank you, Daniel. Thank you, Miro and Mark. And thank you to the audience as well for joining us today.
Thank you for hosting this, Tanya.
Mine.